Hey, welcome to video number 10 in the series. I made it to halfway through my notebook. I didn't start at the very beginning. This notebook does have more than 10 pages. I don't know why I didn't start at the beginning. I'm going to run out of pages. This video, I'm going to talk about two concepts you might see floating around when people talk about risk management, money management, and that's your R multiple and your profit factor. I don't think they're absolutely necessary terms you need to learn or anything, but I do think they can be helpful for different reasons. So let's start with the R multiple. Sometimes it's called your R value. You'll see it like this, like R equals $20 or R equals 10% or whatever. And you might see trades described as like a 2R trade. So what that means is an R is essentially just a fancy way of saying your risk. So if you have a risk-reward ratio of like 1 to 2, what we talked about in a previous video is how this number here is always 1, right? A risk-reward ratio is pretty much just a way to measure your reward, but you're measuring it versus your risk. So this is always a 1. So R is always equal to this number here, right? And the question is, what does that number represent? So that risk, based on your stop losses, based on whatever it is, might be $20, right? So you would say R equals $20. So in this scenario, if you had a 1 to 2 risk-reward ratio, that would mean your take profit would be double. So your profit would be $40, right? That would be a trade where you got a 2R. Okay, and if you had a 1 to 3 risk-reward ratio, and that trade panned out, it would have been a 3R trade, right? So it's pretty much just a fancy way of saying how much is your risk-reward ratio. It is useful for a few things. Firstly, if you're using spreadsheets and you go like 1:2 in a spreadsheet, it's not really going to know what to do with that. Whereas if you just write the number 2, that's just a number. You can use it in all your formulas. You can use it to calculate things a lot easier. Another reason it's useful is you can start calculating your trades over a period of time like this. So if normally you're going for a 1 to 2 risk-reward ratio, but let's say, we talked about in another video how sometimes maybe, a 1 to 2 should put you here, but your signal says, we think the chart's going to go all the way to there. So you end up getting like a 2.5 R, or maybe something else happens where we talked about how sometimes people have a take profit, the price might go up, and then you get a bad feeling, you say, I'm just going to get out here. I know it's a little early, and you end up getting like a 1.8 R. So what you can do after a certain amount of trades is you can kind of find an average of all your trades and say, okay, my average risk reward ended up being, like a 2.2 R, right? That'll help you kind of know what your average risk reward is over a period of trades. And the same thing with your losses. If you have a stop loss down here, you would think your average loss is just going to be, 1R, right? Because your stop loss is, a hard stop. But if you have a stop loss down here, but you kind of price goes down and you say, I'm going to get out a little early, you end up getting out before it hits your stop loss, you can have an average loss of like 0.8R, which means you're actually losing less than you were risking in total, right? So it is a useful way of kind of turning the risk into a number, a single number, rather than using this risk-reward thing, which is this weird combination of two, and it's a ratio, which isn't the best for doing math. So it is pretty useful. I'm going to kind of section that off. Next thing I'm going to talk about is profit factor. I'm just going to write PF. I don't know if people actually do that, but I'm going to do it here just to make it easier. And to illustrate what a profit factor is, I want you to imagine a business that makes $1 million in revenue in a year, right? But it cost that business $900,000 to make that $1 million, like in just all of their expenses, supplies, employees, all that stuff. So you would say that this company made $100,000 in profit, right? Now let's take another company that made $200,000 in revenue, and they spent $100,000 in costs. They also made $100,000 in profit, right? So the question would be, what are the pros and cons of each one? Somebody could come up with reasons why this is better to just have that much revenue. That implies different things. But in general, this is better because it's safer, right? If you had a year where you made, let's say, 25% less revenue, 25% less sales, right? In this case, you would have made $150,000 that year, right? So you still would have made profit. In this case, if you made 25% less sales, you would have made $750,000 and you would have lost money, right? So the profit factor is sort of a way of measuring that, measuring how much wiggle room you have between how much you're winning and how much you're losing. And the way you calculate it is your profit factor is equal to your wins divided by your losses, right? So in this case, you won 1 million and you would divide it by 900K, which divided by 900,000 is equal to 1.11. So in this one, your profit factor would be 1.11. Usually profit factor is written with 2 decimals. On this business, the 200,000 divided by 100,000, I mean, I don't need a calculator for this, but all right. It is 2.0, right? So those numbers don't mean anything on their own. Like, it's not like you want to be at a 2 or a 3, whatever. It just implies that this business has a safer, distance between how much they're winning and how much they're losing. So if they have bad times, good times, it has more wiggle room. If the number is greater than 1, then that means you're winning money. If it's less than 1, how would I do this? That means you're losing money. Means you're winning money. So if you have like a 0.8 profit factor, that means you lost money. Like if you do 750 divided by 900, your profit factor would be 0.83, right? And that means you're losing money. So obviously you want to keep it above 1. If it's exactly at 1, that means you broke even. But you want to get it as high as possible because the higher it is, that means the more wiggle room you have. So to sort of put this all together into like a trading system and how it applies to trading, let's say we have a, $1,000 account, and you risk 2% of your account per trade. That would mean your R value, right? Your R multiple is equal to $20, right? And let's say you want to trade at a risk reward of 1 to 2. So then that would mean that every time you win a trade, that is equal to 2R, right? Because you're winning twice as much as you're losing. So a 2R is equal to $40, right? So you're always losing $20, you're always winning $40. So let's play this out over, let's say 10 trades, right? Oh, and sorry, you have a, let's say, 40% win ratio. That's your win percentage. Let me just write it over here. 40% win percentage. So out of 10 trades, if you got a 40% win percentage, that means you're winning 4, you lost 6, right? So you won 4, so 4 times 40, right, is $160. And you lost 6, and 6 times 20 is $120. Okay, so let's do the profit factor for that one. You would do 160 divided by 120, right? Your wins divided by your losses, and you get a 1.33. So that's good. It's above 1. You're making money. You got some profitability. Now, what if you want to increase that number? Well, the 2 ways to increase your profit factor are increasing your risk reward or increasing your win percentage. So first, let's try increasing the win percentage, right? Let's go to 50%. So to play it out again, 10 trades, I win 5, I lose 5, right? I'm 50-50 now. So 5 times $40 is $200, and 5 times $20, I can do this in my head, but for good measure, is $100. So for the profit factor, again, you should be able to do this in your head. 200 divided by 100 equals 2.00. Right, so you increased your profit factor by a good amount there. So let's find a second way to increase your profit factor. Let's go back to that 40% win percentage. And let's try increasing your risk reward ratio. So now we're going to go from 1 to 2. Let's try 1 to 2.5. So what's going to happen there is your risk is going to stay the same, right? This number doesn't change, but your winnings per trade are going to increase. So it would go from 20 up to 50. Right? If you don't believe me, 2 times 20 bucks is 50. Okay, so we're back to the 40% win ratio. So out of 10 trades, we win 4, we lose 6. 4 times 50 equals 200. And 6 times 20 equals 120, right? This didn't change from up there because the risk doesn't change, the reward changed. So now, let's find the profit factor for that. 200 divided by 120 equals 1.66. So again, we increased our profit factor from 1.33 now to 1.66. We did that by doing our risk reward increase, and we did it by doing a win percentage increase, right? So those are two ways we increased the profit factor. So something to note is that I'm not looking at the actual amount of money I made. Like here I made $40, right? Won 160, lost 120. Here I made $100. Here I made 80 bucks. If I added a zero here, 10,000, that would add a zero to all of these, right? And if I added a zero to here, like instead of 10 trades, I did 100 trades, these numbers would increase as well, right? Let me just show it to you. So instead of 100, this is the original risk reward win percentage combination. So that would be 40% and 1 to 2. So if we did 100 trades, that would be 40 wins and 60 losses, right? So 40 times the original winning was 40%, $40 times 40 is 1,600. And 60 times the original loss was $20 is 1,200. Just pretty much added a zero to each one. And if I look for the profit factor of that, 1,600 divided by 1,200, 1.33, which was the original profit factor. So the profit factor does not change with how much you're trading, the amounts, how profitable, that sort of thing. What it's measuring is the distance between your break-even percentage and your win percentage. Okay, so what that means is as that distance increases, your profit factor increases. As it decreases, your profit factor decreases, right? And that's why I was saying here before, it's all about giving you that wiggle room. This company has more wiggle room to lose and still be profitable. So let's kind of see how that works. So originally, your risk reward was 1 to 2, right? So what was your break-even percentage then? The way to calculate that, in case you don't know, is you do 1 divided by this number plus that number. So this would be 1 divided by 3. The 1 to 2 risk-reward ratio would be 1 divided by 3. You have a 33% break-even win ratio, right? And you were getting a 40%. So that was that distance between there. The first thing we did was we increased your win percentage up to 50, right? So this stayed the same, but this went up to 50. So that distance increased, right? That's why your profit factor went up. The third example we gave was increasing the risk-reward ratio. So now, if we do that calculation, we do 1 divided by 3.5. Your break-even percentage went down to 28, 0.5%. But when we did that third example, we kept your win percentage the same. We kept it at 40%. So what happened there, that distance also increased, right? It went from this much to that much. So you can increase your profit factor by doing one of two things. One is increasing your win percentage or decreasing your break-even percentage. And that's why it's all about that wiggle room. If you're trading at 40% and you have a bad week, a bad month, and you go down to 30%, if you had this situation, you would still be making money, right? Because that's your break even, and now you're above it still. If you had this situation, you would be losing money, right? If you were trading at 50% and you went down to 40%, you would still be making money, right? So that's what profit factor is useful for, kind of measuring that wiggle room, measuring how safe you are within your system. There's no set amount of what you should have. You can have a profit factor of 1.05, and that's a tiny little profit factor, but that means you're making money, and if that's the way you want to trade. But I think it's a useful number to know how safe your system is, how safe it is against, big losing periods. I also think it's not necessarily something that you have to say, this is my number. It could just be something you use as a reference and then try to think of ways to increase it. Or even decrease it. Maybe you say, look, I want to have a little less wiggle room because I want to be more aggressive. It's just another number that I think you could put in your toolbox and help you perfect your system. So that's it for this video, and I'll see you at the next one.